Welcome to episode 15 of the Cashflow Connections podcast. The topic for today is learning from the wealthiest families in the world. Today we're going to discuss some of the pillars of financial freedom from a guest who has spent a tremendous amount of time studying financial education literature, as well as networking with some extremely high net worth individuals and business owners. We're going to discuss some of the key takeaways that keep coming up when you look at some of the wealthiest families and how we can implement similar strategies to help us for our own financial future. Obviously, each of our listeners will have a vast variance in terms of the different stages of their own personal financial planning, but no matter what, it's always a good idea to continue to educate yourself on these type of topics. Of course, I don't need to tell you that, you're the one listening to this very podcast, but sometimes I think the best way to get as much financial education content as possible is to have a really detail-oriented conversation with someone who has spent a lot of time focusing on the subject matter. And so this is exactly what we set out to discuss today. Also, we discuss an investment strategy which I'm not very familiar with, which involves utilizing an insurance plan to purchase real estate, which apparently allows you to receive distributions and gains tax-free due to the structure of the plan. It's really a unique structure, and I'm sure that most of the audience is not going to be familiar with it. In fact, originally we were just anticipating summarizing the topic, but I can't really help myself. When I'm learning about something new that I find interesting, I'm just going to ask questions and get as much out of the conversation as possible. So I really think it's an interesting conversation for sure. Now, just a quick update. Recently, we have been in the process of having multiple different closings simultaneously, which is kind of why things got a little crazy there. But now that those closings are done, my schedule has slightly opened up. So if you have been hesitant to contact us or get on the phone with me personally, don't hesitate to reach out. I'm always happy to network with new investors and seasoned veterans. It really doesn't matter to me. I always want to get a good idea of what people are seeing in the marketplace and share my perspective. And this is really what real estate is all about. I mean, one of the reasons I love the business is that you necessarily have to be good at interacting with other people in order to succeed at it. So for example, with stocks, you can sit in front of a computer for 12 hours a day and make a lot of money. But with real estate, because it is a network-based business, it's always important to communicate and share ideas, etc. I mean, that's exactly what this podcast is. So if you haven't yet sent me an email, you can send me an email at hunterthompson@cashflowconnections.com. I'd love to schedule a 20-minute call with you just to kind of introduce myself, hear about your interests, and hear about your background, and kind of see if there's a good way for us to leverage each other's network and interests. Now, without further ado, let's get straight to the interview. How's it going, everyone? Today, our guest is MC Laubscher, who is a wealth strategist, educator, and financial freedom fighter. He is the president and CEO of Valhalla Wealth Financial and creator and host of the popular business and investing podcast, Cashflow Ninja. His mission is to help as many people as possible eliminate the control banks and financial institutions have over their lives by building their wealth in a variety of ways outside of Wall Street. He believes the best way to achieve this is by reclaiming the banking function in your own financial life through structuring an efficient cash flow management system and creating and building assets that provide multiple streams of income. MC challenges existing societal beliefs and misinformation around concepts such as money, saving, investing, wealth, and retirement. So MC, thank you so much for coming on the program today. Really looking forward to this one.
Thank you so much for having me on the show. Honored to be on.
So you have a pretty tremendous background and you're obviously in the middle of accomplishing quite a bit. Let's talk a little bit about, the big picture. How did you get started on this program? How did you get started on starting this current company that you're working for? And is this the first company that you actually started?
Yeah, so a little bit about me. I'm originally from South Africa. I grew up in South Africa. I was born and raised there. Went to university there, and after grew up in a very, very interesting time in the country's history. I was in primary school when Nelson Mandela was released, actually from prison in 1991, and then in high school in 1994 when he became the first democratically elected president of South Africa. So a very, very interesting time to grow up in. In 2001, I came to the United States, backpack, a suitcase, a sense of humor, and a sense of adventure, and about $500. I traveled quite a bit, and I actually played in like a city-based rugby league. The league doesn't exist anymore, but it was at that stage called the U.S. Rugby Super League. Did that for a couple of years, played representative rugby. But I think what got me started on this path that I'm on right now is when I finished university, I came across this purple book, which a lot of your listeners might have come across on their journey as well, Rich Dad Poor Dad from Robert Kiyosaki, and that kind of took me down and made me realize that there's a different road here. I was very fortunate through the years. I went to very grateful that I was able to attend quite a prestigious school and university. So I've been in contact with families that have built legacy wealth and have been very, very wealthy. And there's certain things that you pick up, but that book really made me kind of just realize everything that I've seen, but I didn't really realize that I was seeing that. So that took me down the rabbit hole of just researching and learning as much as what I can. I purchased actually my first real estate investment the first year out of university. So 2-bedroom, 2-bath, a property in South Africa, and kind of went down that. In the United States, I started and I came across a very wealthy private real estate investor, and this was while I lived in Chicago. And I wasn't smart enough to figure out, Hunter, that I have to find a mentor to try and learn from. I kind of fell into this by accident, and it was quite an eye-opening. He was a very, very large owner of multifamily units in Chicago, and owned a lot of units. So I kind of learned the business from the ground up. I started doing like little maintenance work, turning apartments over, some painting, property management, roles as in leasing property, structuring leases, marketing the apartment units in the respective neighborhoods that they were, to doing the books, negotiating with vendors, contracts on all of these buildings, learning a lot about the property management side and the operations in and outside of a building, to eventually becoming part of an acquisition team where I had my broker's license, trying to find deals so I could learn what they look for. So it was really, really insightful, and really, that's, I refer to as when my real education actually started. But I also at that stage kind of saw also, that these guys were exposed to different strategies, more high-level strategies. There were certain products and vehicles that they utilized to dovetail with real estate investments in their own life, to structure their affairs in a certain way for their family, so that this wealth that they've built up and assets could be transferred from one generation to another generation without really being exposed to the massive wealth-destroying factors such as taxes, such as inflation, fees, commissions, from financial professionals and so forth. That really intrigued me and made me study everything I can about, what's going on in family offices. This is high-level type strategies and planning, from estate planning, from insurance planning, which is a very, very big part of what they're doing, asset protection, tax planning, and then dovetailing it. So, and I realized that these guys, it didn't really matter what the markets were doing. They were positioned, markets go up, down, and sideways, as a very wealthy individual told me the one time, if you don't have a strategy that fits in all three scenarios, you really are not in control. And that's another thing that I've learned from them too. But I started Valhalla Wealth Financial utilizing and teaching the same kind of strategies that I've learned and researched and been exposed to, and dovetail it nicely with investments outside of Wall Street. So our tagline is kind of helping you build your wealth outside of Wall Street. So it's not stock market correlated vehicles per se. It's, and a big focus, and a lot of the people that I work with families, individuals, entrepreneurs, investors, a lot of real estate investors, because some of the strategies that we utilize dovetails extremely nicely with that. Valhalla Wealth, talking about companies that I've started, this was, I would say, the first one in this niche. I've always been kind of an investor, but to take on a company of and a venture of this level, this was kind of like the first one at this level that I took on. There were a couple of other adventures that I was part of that was unsuccessful, and that I've learned a lot from. So there's a couple of other things that I went into partnerships with folks and so forth. But this was really one that I felt my purpose was aligned with, and very passionate about just helping people implement and execute these strategies that we teach.
Awesome. Well, I'm definitely interested in getting into some of the details of those. So one of the things I wanted to cover, I know that I'm listening to your podcast, which, by the way, will be linked in the show notes page for those that are interested. I can tell that financial education is a key driving factor in your entire life. And it's always great to have conversations with people who have devoted countless hours to reading financial education, because, in a 1 hour conversation or so, you can get an incredibly condensed version of their perspective of accumulation of what they've kind of reviewed. And the fact that you have a podcast in which you do something very similar, which is talk to some of the most influential people in finance and otherwise, I'm really looking forward to this conversation. So let's talk about, your philosophy on financial freedom per se. The topic for today is the 6 pillars of financial freedom. Tell us what your perspective is on those pillars and what they are.
Yeah, I think the first one is mindset. And, this is what I learned from all of these people that I'm fortunate enough to spend time with, such as yourself as well. And mindset is, the wealthy people look at themselves and they know that their number one and greatest asset always is themselves. And they spend hours developing themselves and personal development, number one, their mindset, and then also their financial education, and also increasing and adding skill sets. They understand that the world is changing rapidly, very, very quickly, and that they have to unlearn old bad behaviors and thoughts that are no longer applicable and update it to new ones. And they do this very purposefully and with intent. And that is a very, very important part, because you hear mindset. Okay, great. Yes, mindset. These folks plan for it. So they make a decision to invest in themselves. They actually put money aside every single year to invest in themselves, whether it's traveling for seminars, whether it's books, whether it's courses, whether it's mentors and coaches. This is done with purpose and intent. They operate from a mindset of abundance. We live in an amazing time. The world is truly our oyster, right? You and I just talking right now over the internet, and we could provide and serve people all over the world. There's really not a ton of restrictions, and this brings with that worldview and mindset of abundance. What I've learned from very successful people is, there isn't even necessarily competition anymore. Everybody's collaborating because we're not fighting over a small pie. We're all just trying to make this pie that we have so big so that there's an unlimited amount of pie for everyone that's involved. And that was really eye-opening. So you'll find at really high-level masterminds that there might be people in the same industry, and that quite frankly, everybody else would view as competitors, and they are sharing their best practices, what's working for them, and so forth. And this has been very eye-opening for me, and it really has changed my life and the way that I do business. I have conference calls with folks that you would consider to be my competitors in my space, and we share best practices, what we're working on, how to grow this pie together. And wealthy people, to add to mindset, is that they know the universal law. And that is, when they put out as much value as they humanly can for others and try to serve others, and try to serve an unlimited number of people in the world, they know that value is going to come back into their life. Now, whether it comes back in the form of money, is one thing. Everybody has a different currency. Every single person has a different currency. It might not necessarily be money. It might be, actually devoting your time and contributing to someone else's time, for a charity of their choice, for instance. So they definitely have that figured out. The second part, I would say, is they have a vision and a plan, and then develop a roadmap from that. So, which is very, very important. You've made the decision to invest in yourself, your number one and greatest asset. You have a vision for your life of what you want it to be, but how do you get there? I think that's one thing that when people look at very successful people, they look at, for instance, like a Tony Robbins or an Elon Musk, or name any successful person, and they think to themselves, well, wow, they must have gotten lucky somewhere along the road. And the answer, quite frankly, is not necessarily they planned for that. They had a plan. They think long term. They think in 5, 10, 15, 20, 30 years. A lot of very wealthy individuals think in not only their life, but their children's lives, their grandchildren's lives, and their great-grandchildren's lives. They have a very, very long-term range in view, and they plan for that. So they plan where they're going to be in 5 years, in 10 years, in 15, in 20 years, with that vision that they have for themselves and their family in their mind. The third pillar that I would say is they network. They develop a network. And, this is something that every single person can do wherever they are in the world. If you have access to the internet, you go to meetup.com and you can find like-minded people. If you're unhappy with the people around you, you can find like-minded people that want to go in the same direction as you're going. And this is very, very important too, the way that they operate within networks. What I find, and this comes from starts with mindset, right? When you come from a mindset of scarcity, you go into network with people, and a lot of people go into networks and they try to take what they basically can, quote unquote, from that network. That never really works. What I've seen is these folks, they go in and they provide as much value as they humanly can to that network and become an asset of that network, so that everybody is basically falling over their feet to find out how they can help them. I'll give you a good example just of this in what I've seen online too. There's Facebook groups, and a lot of people that are listening probably belong to Facebook groups. And then sometimes, there's some people in there that post extremely valuable content all the time. They try to answer other people's questions. They add value. They discuss, they comment, they provide advice. They share some of their stories and best practices with people in that group. And I guarantee you, when those folks that have done this, and I've seen that, by the time that person is just looking for, maybe possible an answer to their problem or a challenge they're having, people are falling over their feet to just help them. And I know I can think of an individual in my mind right now. I just want to jump in there and try to help them as well. So I think that's very important. The team, the concept of a team, of surrounding yourself with advisors that play at a bigger level than you do is extremely important. They know the value. And then, the fourth part, which ties into, the industry that you're in as well, as wealth capture. Wealthy individuals know how to capture their wealth and then leverage their wealth to go and create more. Real estate is a fantastic vehicle to do that, and to basically capture that wealth and leverage it. Some of insurance products that I deal with is a very good vehicle as well. That's why a lot of wealthy families use them in conjunction and dovetail them. Number 5, I would say, is just wealth strategies. Very high level wealth strategies that they have their team members help them implement and execute. Robert Kiyosaki said you can invest like a rich person, a poor person, or a middle class person. And that's so true. I've invested in real estate as a poor and a middle class person, and I've invested in real estate as a rich person with a rich person's mindset and strategy. And the difference is astounding. And I'll top
Yeah, I
off
can
the
certainly relate to that.
yeah,
I can certainly relate to that. I've
exactly.
had, guests in the past talk about their first foray into real estate. And I'll put it this way, for those of you that are listening that are just getting started, and this is just my opinion, you may have a different opinion, but you very rarely hear someone say that they started in commercial syndications and leveraging experts' expertise, and they ended buying single family houses away from the state that they live in. So that's kind of a clue as far as most people's route go the other direction. It's not necessarily the best route. Usually people start in single family houses, buying a $35,000 house, renting it up. But boy, oh boy, that is not how the richest families in America invest. And it's attainable regardless of your net worth. So it's definitely something to keep in mind. I don't want to interrupt you because you're definitely on a flow, but just wanted to, that touch personally with me. Absolutely. So go ahead and move on with the sixth as well.
Yeah, the sixth one is very, very important too, and that's giving. And this is one thing that I've seen, and everybody's seen this. You go to whatever city you go to in the United States, they'll have the name of some of the wealthiest individuals on there. Some of the buildings don't even have their name on; they're anonymous. But these people are very giving, not only with their money, but things that they create, and then also with their time. And that's one thing that I've learned. And this is something, Hunter, that we could start. Every single person can start right away. We can start today by giving. I mean, if it doesn't need to be money, it could be your time. It could be an hour a week. It could be 2 hours a week that you're contributing to a charitable organization that you feel passionate with. And I think once you start doing that too, it really changes. It really, really, really changes your perspective. And it also brings in gratitude, which I've seen with a lot of the wealthy individuals that I've interviewed as well. So a lot of us, I would say, I didn't leave it as the sixth step at the end of it to be the last thing that you do, but they start giving right away, and they give throughout their journey. And then obviously when they're in a monetary position, at the end of their life, they obviously give a lot of money as well, but they give their time, they give their resources, and obviously things that they create. So that's kind of like the 6 pillars of the Money Masters playbook that I've put together.
Man, I really like that. I mean, you touched on so many things. And obviously, the key obviously is I think that a lot of people listening are familiar with those strategies, but it really comes down to implementing and executing. And, that's something that some people struggle with. There's plenty of people out there that have read all the financial books in the world, and that it's kind of like a hobby to them. It's not something that they implement. But, and then there's other people out there that are just kind of going about their business without kind of thinking at the big picture. And it's always good to have a balance between the two. Now, something you mentioned a couple times that I want to definitely touch on is the insurance policy. Now, I'm not very familiar with this policy. I've heard about it. I've heard different versions of it, but I'm interested to hear your perspective on this, given that you're quite knowledgeable on the topic. So from a big picture perspective, explain structurally how this investment vehicle works, because most of these listeners, most of my listeners in this podcast will be not very familiar with this type of strategy.
Yeah. So, this strategy basically is based on banking principles, because the banking system is one of the most powerful systems that are out there. And Nelson Nash wrote a book, Becoming Your Own Banker. And what Mr. Nash was writing about wasn't necessarily that every person should go out there and start a bank. But what he was saying was that everyone should reclaim the banking function within their own life and be in the quote unquote banking business. You be in the banking business and in the business that you're in. So if you're in real estate or in another business, make sure that you're also reclaiming the banking function and be in that banking business. Now, how the strategy basically work. And again, I just want to touch on something I said earlier, is that we all have the ability to utilize the same asset classes. It's the same for everyone, businesses, real estate, commodities, we have paper assets and now digital assets, but it's how we invest in them and the systems and the strategies that we have in them that determines our success in them. So we build a system utilizing dividend-paying whole life insurance with a mutual insurance company. And if this is the first time your listeners may hear of this, their jaws might drop to the floor, because everything we hear about insurance
Right.
actually is negative out there. We make fun of insurance people selling insurance on movies and TV shows, and he's kind of like the guy at the cocktail party being laughed at, and everything else that we see it as an unnecessary cost. Just bringing it back to the mindset of the wealthy people, besides number one, always having control over their assets and investments, risk management is one of the biggest key fundamental parts of their armor. That's why Warren Buffett, for instance, loves insurance companies. Warren Buffett does not go into a deal without protecting his downside, knowing how to manage his own position, and transferring a risk onto a third party that he's not willing to take on himself. He just will not do that. And that's what these folks do. And then the third leg of that is economically efficient, to try and position your assets to do more than one job at the same time, which real estate, and I'll get to the insurance part of it, both of these vehicles have the ability to do that. Let's look at real estate, for instance. There's a cash flow option. It provides cash flow. It's also an inflation hedge because we can raise our rents with inflation. Then, of course, there's appreciation and tax advantages through depreciation, and we build up equity in it. So the same dollar is doing a lot of many things here at the same time. Now, when we utilize this vehicle, this dividend-paying whole life insurance vehicle with a mutual insurance company, it does the same thing for us. Now, it's with a mutual insurance company, which is different than the PNC and the stock companies listed on the stock exchanges. The mutual insurance companies are not listed, as I mentioned, on the stock exchanges. They've been around since the mid 1800s. Very, very conservatively managed with a very long range view in mind. And when we utilize this chassis or this structure, specialized structured dividend-paying whole life insurance, the number one thing that it does for us is it provides a place to park our money. We have to warehouse our wealth somewhere. So from a risk management standpoint, one of the biggest risks out there right now is institutional risk in my mind. And I'll give you an example. In 2008 and 2009, if you shorted the S&P and the Dow Jones, but you had your money in Lehman Brothers, you lost regardless whether you were right or not. So institutional risk is a huge one, and we have to park our money somewhere. So that's why a lot of wealthy families park their money there. These companies have billions of dollars in excess reserves, which means that they can pay out all of the claims on death benefits that they have to pay out and still have this money on there. So when you deposit the money into this vehicle, it provides security, it provides certainty, predictable growth, and then you can access dividends, which is not guaranteed, but these companies have paid them out, through the Great Depression. There's a carrier right now that they paid the same dividend for the last 9 years consecutively. So during the last financial crisis, which is one of the worst that we've seen out there, these guys didn't bat an eyelid. So that is that job that it does for us. The second job that it does for us is to provide a death benefit. Now, along with the death benefit that goes tax-free to your heirs, up until about 11 million is kind of like the cap. Then other estate planning strategies comes into place. The growth inside while you're alive is also tax-free. So it has that advantageous sides to it as well.
Okay, wait, before we go on, I want to understand, because this is definitely new content. So the way that I understand it, you basically invest in, or you have your capital parked in an insurance policy, right? And then you have your assets parked in an insurance policy, which can pay you dividends. Now, the dividend is paid by the insurance company. Is that correct?
That's correct.
Okay, and so if you have, let's say you have $100,000, you basically purchase a $100,000 policy, and then how do you get a cash balance back from the company immediately? Is that correct? Or a cash withdrawal? You have the ability to withdraw the balance of that policy, I believe, right?
Yeah, yes, because you'll deposit your money. So say for instance, let's use the $100,000
Hmm.
example. Now, when you deposit that into, say, that the way that these policies are structured is to maximize cash value. So let's just say there's going to be an insurance component of that. So you're not going to have $100,000 in cash value readily available.
Right.
Um, there's going to be also a couple of more, when you make a deposit of 100,000, let's just say you make 10 payments of $100,000, or we spread it across a little bit, because we can't just dump in all the money at the same time, because then, not to get too technical, but there's a ratio between life insurance and death benefit that
Okay.
keeps the plan from becoming a modified endowment contract, which then it loses its tax favorability. So let's just hypothetically say that you're going to keep making that. Well, in a couple of years, there's 3 phases. The first phase is that the money's going to accumulate. So you're not going to have exactly the same amount of money. Let's just say in this example, you have, let's just say $85,000 available, to be very, very conservative in cash value.
Okay.
Now, after putting in a couple of years, there's going to be an accumulation phase. Then there's going to be a time, using this example, probably around 4 or 5 years, then you'll have the money in there that you deposited in there, and then it grows, and then there's exponential growth in that. So it's not a get-rich-quick scheme, but it's done a couple of things for you. It's put your money into a vehicle where there's predictability and certainty and growth. Yes, you're not going to have the first couple of years. It's not apples to apples. And that's why I say to people, I share all sides of this, from a quick at bat, or a quick stock tip or something, if a Bitcoin, something making 100% or 200% for you in 6 to 12 months. This is not it. This is a very long-term strategy and play, with a long range view. But I think the power comes in once you build that up on that side. You've got your money deposited in there. It's growing. It's earning dividends. It provides a death benefit.
So
You can borrow.
Sorry,
go ahead.
I just want to be clear on how is it growing? So you have, let's say you're making your deposits of $10,000 a month, and eventually let's say the cash balance is 85,000, or the cash value is 85,000. You can
Yeah,
invest in anything, isn't that right? With that cash balance. And is then
absolutely.
the dividends are then paid back into the policy, and that's how it's growing?
So no. So yeah.
Okay.
Well, let me put it this way. So let's think of it as 2 separate transactions, just like a banking system. So we have a deposit side where you're depositing in the money. It grows and it accesses dividends on the deposit side. Then, just like in the banking system, there's a lending side. The lending side allows you to borrow money from the general account of the insurance company using your cash value as collateral.
I see.
So 90 to 95%, some carriers. So if you have let's just use the 100,000 for round numbers. If there's $100,000 in cash value, let's just say at that stage you have the ability to borrow $90,000 from utilizing your cash value as collateral from the insurance company. Now you're borrowing that at 5%, okay? And again, this is a separate transaction, but at borrowing at 5%, you can invest that into, self-storage, multifamily housing, real estate investments. That's paying you, 8% preferred rate, possibly. 10%, 12%, regardless of the return. There's arbitrage in play between the borrowing, the 5%, and then the return. You can at that stage then pay the policy loan back. Once the policy loan's paid back, you can look for another vehicle to invest that in. So that's kind of the strategy that we teach, because at that stage your money is doing many different functions at the same time, and it's positioned to be as economically efficient from a tax standpoint, from limiting and reducing fees, and then also, with all the other benefits that I play with it, just utilizing, for instance, a real estate vehicle to invest in.
Got it. Okay, cool. So there's something that I heard, and maybe the crossover isn't that relevant, but I definitely want to get your perspective on it. An investment vehicle called Indexed Universal Life that I've heard a lot about, where buyers of the policy essentially have an investment instrument that is tied to something, let's say like the S&P 500, but there's a ceiling and a floor to its tracking of the S&P. So for example, there's like a 14% ceiling and a 1% floor, meaning that if the S&P 500 goes up 22%, the investor or the policy would receive, let's say, a 14% return. And if the S&P 500 goes down by 22%, the policy owner receives a 1% return. Is this similar in some way to this index policy, and that it's tied to insurance, but it just happens to be more flexible, or is there any correlation there?
It's also an insurance product, so there's a quite a number of differences. So I'm actually licensed to do both, but I don't do universal life for a couple of reasons. So if I look at the three-legged stool, the first one is control, the second one is risk management, and then the third one is fees. Um, and universal life has been around since the 1980s, and it has the allure of participating in the stock market with a floor to protect you. But it basically, what it did is it broke it up into a part where there's a renewable insurance, which really is not that fixed. And then the variable is the stock market. So it doesn't, for the strategy that we're trying to employ, is we want to build our vehicle on a very, very solid foundation where there's predictability. 5 years, 10 years, 15, 20 years from now, we can plan for that. And because it's tied to the stock market, now you bring in mutual funds into the situation,
Right.
which doesn't do well with the fees. So as far from a cost and a fee standpoint, risk management and control kind of standpoint, it doesn't really necessarily tick all the boxes. So the same strategy, I'm an infinite banking practitioner, which is part of the Nelson Nash Institute that teaches the strategy. And this is not a vehicle that's utilized for the strategy because of all, the things that I just mentioned about fees and, the unknown variable. So we try to limit and reduce unknown variables. As far as fees and commissions, the market risk, and so forth, your tax liabilities moving forward.
Okay, cool. And is this something that you can hold in an LLC, or does this policy have to be in your personal name?
No, so this is in your personal name. This is a really good question. It does provide asset protection in 43 of the 50 states. Please check with your lawyer in your state to verify, because some state protects it up until a certain limit that you have in there, and some states have full protection. So it varies. You can, through different strategies that we teach, but you can actually make the trust the beneficiary. In some family offices, they have trust that's the beneficiary, so the money then passes on to the
I see.
trust.
Hmm.
And then to access that, for instance, legacy families, their heirs would have to take out similar policies to access the money in the trust. So when they eventually pass away and they didn't pay back the money, the trust is made whole. So that this way, money's transferred from one generation to another generation, and the trust keeps growing.
Got it. So so the way I understand it now is that the loan that you can potentially take out with your policy as collateral, or the cash value of your policy as collateral, I should say, is optional and is not necessarily part of this, but it is an option to have relatively inexpensive leverage if you want to take advantage of it. Now, first of all, is that correct before I move on?
Yes, you have
Okay.
that is correct.
Okay, so is it possible then, do they need to, this is a private transaction, and do they need to know what you're investing in? Can you say, I'm actually going to buy a Tesla. Can I have 100 grand out of my insurance policy?
Yeah, and that ties in, because initially my first thought too was, well, is it restricted? How is it restricted? And the thing is, this is your money.
Right.
This is not like qualified retirement plans, like a self-directed IRA or a 401k. So this is again, post-tax dollars too. So this isn't, money that you're putting into this vehicle and you're paying taxes later. So this is after the money comes out of whatever vehicle it's in, then it goes into this vehicle, post-tax dollars. And this is your money. So if you wanted, as using your example, if you have enough cash value in there to pull out and go buy a Tesla, you're welcome to you're
Okay.
you're welcome to go do that, because again, it's your money. So it's a different mindset too. I get a lot of questions, especially with the Roth one that has restrictions of how much you could put in and
Right.
when you can use it and what you can invest it in and how much you can pull out and so forth. So with this, this has been around a long, long time before any of these qualified plans.
Okay, cool. And you mentioned the track record of some of these companies. Given that these are not going to be publicly listed, what is some of the ways that you verify these companies' background, their ability to pay dividends, et cetera? You mentioned the company that had paid it for 9 years, for example. What are some of the mechanisms you use to verify that?
Yeah, so they have their financials available, and they do have the dividends that they've paid out available for you too. So a lot of these very kind of, I mean, they're legacy companies. So when you look at their financial statements, you can access that. You can access their dividend. You can also see for benchmarking purposes when you do your research. A lot of these companies announce it, so it is available. And you can compare between them. And this is one thing that I do like about it too, is you actually have to go in there and you can do your own research on it, where I think with the current banking system, our mindset is just that of, oh, my bank's fine. I don't
Right.
I don't have to look at their books, right? They're fine. And they have the FDIC because that's
Exactly.
going to work out in the next crisis. So,
Right.
unbeknownst to the provisions that's in the Dodd-Frank bill, yeah. So I think it's a good question that the information is available, and anyone looking into this should be able to grab those information from the respective companies.
Okay. Awesome. So one more question then, just on the topic of insurance, because it came up. So in the event that you don't pay, let's say you do take on that loan, you have this favorable interest rate, you invest in some real estate, for whatever reason it doesn't perform as projected. What then happens? Because they have the collateral. Do they then decrease the balance or the value of your policy, or what takes place there if you are unable to pay back that loan?
Yeah. So what would happen is, from a risk management standpoint, is the payback schedule is set by you. So say for instance, one of my policies, I borrowed through a policy loan money to start my financial firm. For the first 9 months, I didn't pay any of the principal back because I wanted to get my company ready and have my cash flow at a certain level before I start making those payments back. So I guess what I'm trying to say is there's a lot of flexibility in these policies. Number one, from a downside protection at the end of the year, the only thing that's really due is the interest on the policy loan. So if there is a hardship, for instance, that you're not going to make a payback, you can also, if there's other cash value available in that policy, get another policy loan to cover the interest that's due until you can start making payments back. So I guess what I'm trying to say is, the feeling of working with these companies are a lot different than working with, for instance, a lot of Wall Street financial firms, because you are a policy holder. So they want you to stay involved with their company and part of their company. So they're looking to work in many different ways with you to be able to do that. And there are different options and strategies available from protecting that downside. So it isn't just a fact of, okay, you can't make the payment, you you surrender the policy, and now there's a bunch of penalties and fees.
Right, right. They act like they're actually a business which is subject to its customers, right? As opposed to dealing with something like well, I don't want to name any names, but you know the names I'm thinking about.
Yeah, exactly,
Okay.
exactly.
Awesome. Awesome. Well, I really appreciate that explanation. That's definitely something that I'm not very knowledgeable about, but I've heard it bounced around a couple times. So I'm definitely glad we got to get into some of the details there. So let's talk about some big picture stuff, including, your experience and your education on this topic. So it sounds like you have been surrounded by people that have been pursuing financial education and wealth for quite some time. You've talked a little bit about a lot of the mechanisms that people utilize to achieve wealth, to maintain wealth, to transfer wealth, etc. What are some of the things that you have learned not to do from either your own personal experience or from some of the people that you respect around you?
There's quite a number. But I think one of the things that I would say is, I was maybe a little bit too trusting. So that's one of the things I would trust but verify. And really due diligence. I mean, in every single investment, I think in the past, do not skimp over that. And it starts with vetting sponsors. If you're investing in a vehicle, it starts with vetting companies, with people that you do business with. Um, you know, you have to do your due diligence with the people that you do business with. So I would say that just don't go on a handshake and everything's going to be all right. Because not that I'm saying that there's necessarily everyone's bad and there's a lot of bad people out there, but you're going to come across some characters out there. It's just the law of averages, right?
Totally.
Um, so I would say that definitely from that standpoint, and then I would also say um, confidence is a big thing, and emotional intelligence is something that you come into over a couple of years. And I'd never really understood that when I was reading about this when I was younger, but I would get emotional about investments or businesses or things going the wrong way against me. I think that once you've invested in your financial education, once you've done your due diligence, you've done your background, your homework, you kind of know your exit strategies, you know how to manage your position in a place, you're going to have more confidence and you're not going to be as emotionally tied. I found that some of the worst decisions I've made in my life was when I was emotional. It's not a shocker. Again, this isn't original content that I'm sharing here, but just a personal lesson that I've learned. So and I would say that emotional IQ will keep going up, especially when it comes to your investment, with the confidence that you have as you're gaining more experience and learning more from others. So those are just some things that I would say not to do.
Yep, totally makes sense. Looking at the perspective, people have a 3, 5, 10, 30 year plan. What are you most excited about for the next 5 or 10 years?
I am very, very excited to just see where all this is going with the internet. Number one, we're in podcasting right now, and videos are great, and there's live streams on Facebook and so forth. I really can't wait to see what's coming up in 5 to 10 years with the technology. I think we're just going to get closer and closer as the world. My parents just visited from South Africa, and we were just talking about when I first came to the States. I had to go and buy a calling card from 7-Eleven,
Hmm.
and then I would have to type it in and call. And now basically, we FaceTime just through technology or Skype. So from that standpoint, the technology really, really excites me. I can't wait to see where this is going. The digital space, as far as the cryptocurrencies, is extremely interesting and intriguing because, there's a lot of collapsing systems out there. The world is changing really fast, and there's a lot of systems that are outdated, corrupt, and really institutionalized means of theft, really. And I think it's pretty exciting to see with technology, these new systems that people are building outside of existing systems that are old and decaying, that'll eventually take this over. So that's very, very exciting to see that. From a business perspective, I'm about two and a half years into my company. I'm really excited to see where it's going to be in 5 years, because just the I would say just the evolution of the business itself in the last 2.5 years has been quite remarkable. You start with a purpose and a mission and a vision of what you're trying to accomplish and do and where you're going, and you stay on that path to obtain that vision, but things that come into it as you meet new people and you're exposed to other ideas and other technologies and so forth, it's pretty exciting stuff. And it's just something that happens. A good example is the podcast that I have too, and you will be able to relate to this as well, because when you start with a podcast, you might have an idea in mind of what you would like to accomplish it and do. And then all of a sudden, the same core principles that you started with is still there, and that passion and that vision and that mission. But what you are able to build after a while really just, you step back and you go, wow, because I met this person, this kind of happened. And because I met that person, that kind of happened. So I'm pretty excited to see where this is all going. The online community that's developing with this abundance mindset is also just blowing my mind on a weekly basis, of people that collaborate and trying to just add more value in as many ways as they can. So I'm pretty excited to see where that is all going as well.
Awesome. Well, MC, I think that's a great note to end it on. Just covered a tremendous amount of information on some interesting topics. I will make sure and link to your company as well as your podcast, and anything else you want to just give yourself a shout out. Just let investors know how to contact you directly.
Yeah, if any of this that I discussed is interesting to you, I do offer a ton of educational resources, as you mentioned, on cashflowninja.com. I have my own show as well, where I interview people that create income streams from gold and silver, digital currencies, real estate, anything you can think of. Coffee farms in Panama is one of them. So we have all type of individuals on there with different ideas and unique perspectives. So check that out if you're interested. If you're interested in what I spoke about earlier, and if you want more information on that, there's actually a webinar that I share. It's about an hour. I try to pack as much content into it as possible. You can access that at cashflowninja.com/be the bank. Just from an educational standpoint, there might be something that of interest for your listeners. But thank you so much for having me on the show. It's been a blast.
Absolutely. Now, for all the listeners out there, if you want to contact MC, feel free to check out his wealth planning website at valhallawealth.com, VALHALLA wealth.com. They have a contact form. You should definitely also check out MC's podcast. It is unbelievable, the quality of guests that he has. Robert Kiyosaki has been on there. Robert Murphy is going to be on there soon, and that is the Cashflow Ninja on the podcast app. It's regularly ranked in the top 100 in terms of business podcasts. As far as what I mentioned earlier, don't hesitate to contact me as well. Hunter Thompson at Cashflow Connections. I will send you my scheduler, and you'll be able to select a free time that's convenient for you. And again, love to network with investors, love to discuss new topics. We'll be happy and excited to meet you, especially since you're a listener to this podcast. Probably we'll have a lot to talk about. Thanks a lot.